Hello and welcome to the Friday market update. Well, let's start with the mortgage rate. Because that's where we saw some movement this week. Mortgage rates dipped down a little bit to 6.15%, which is good, going in the right direction. And the reason matters. We received several weaker than expected jobs reports that Wall Street pays close attention to. The first one was ADP employment report, and it showed softer private sector hiring. It wasn't that great. Then the JOLTS report, which is the job opportunities and labor turnover report, that confirmed a continued decline in job openings. A lot less jobs out there for people to grab onto. Fewer job openings usually signals that companies are slowing down their hiring plans. But the report that really caught the attention was the Challenger Job Cut Report. What the heck is that, right? So this report tracks announced layoffs by U.S. companies, not estimates, not surveys, just actual job cuts companies publicly say they plan to make. And think of it as an early warning system for the labor market. Now, this month, the Challenger report showed job cuts at the highest level since 2009. That's a pretty big number. That's a long time ago. That tells us companies are becoming more cautious and preparing for slower growth. Now, why does this matter for mortgage rates? Because a cooling job market reduces inflation pressure, inflation on wages. When inflation pressure eases, the bond yields or the mortgage rates often fall, and the mortgage rates tend to follow. Now, here's the next big thing to watch. Next week, we get the Bureau of Labor Statistics jobs report, the BLS report, commonly called the BLS report. This is the Big Daddy jobs report, and it's the one Wall Street and the Federal Reserve care about most. So if that report confirms what we saw this week, which we expect it would, softer hiring and a cooling labor market, we could see mortgage rates move even lower next week. So that brings us to housing. So this week, the Wall Street Journal published an article noting that the housing market is swinging toward buyers. We've all seen it for a while, but the Wall Street is kind of that independent third party. We're not just headed for a crash, not a collapse, just more balance. And at the same time, Cotality, which was formerly known as CoreLogic, raised their home price appreciation forecast to 4.5% for existing homes, and that being up from 4.1%. That's a pretty significant increase. And they did that because demand remains resilient. Inventory is still limited, and homeowners are not under pressure to sell. That's why the crash narrative continues to fall apart. People waiting for the crash are going to wait a long time. We still face a massive housing shortage in this country, estimated anywhere from 3 million to as many as 20 million, some people think. Builders just cannot build fast enough to close that housing gap, and the rising construction costs for labor, materials, and land continue to support existing home values. So existing home values should continue to be maintained. Now, new home sales are increasing, which is healthy, but that does not undermine the resale values. In many cases, it helps stabilize the entire market. Now, let's tie it all together. So historically, there is a very strong relationship between lower mortgage rates, which were down from 7.25% last year to the 6.25% that we're about at today, and the rising pending home sales. Even small declines in rates can bring buyers back in off the sidelines into the market. And there's a lot of pent-up demand out there. Inflation is totally moving in the right direction. The job market is softer than the Fed previously believed. And the combination opens the door for further rate declines, which we predicted earlier this year to come down to 5.7%. That's our goal. That's our prediction. So here's the big picture. Rates are easing. The market is becoming more buyer-friendly. Home values are remaining stable with continued appreciation, and the supply shortage is still doing the heavy lifting, keeping home values up. So if you're waiting for a crash, if your clients are waiting for a crash, the data says it's highly unlikely. If you're watching for opportunity, this market is quietly creating it. We're seeing a lot of momentum with the Friday playbook. It's a fast, focused 30 minutes every Friday morning at 8:30, where realtors jump on to stay current on mortgage rates, market direction, and what's actually working right now in the market. We cover where things are headed, share buy better and sell smarter strategies, and walk through real success stories from the field. So the goal is simple: help you stay relevant, confident, and prepared for the conversations your buyers and sellers are already having. As I say all the time, we're available 363 and a half days per year, only off on Christmas, and a half day for a Super Bowl. So I'm not taking any calls starting at kickoff until the final buzzer goes off. So have fun at your Super Bowl party. While I don't really care for either team this year, I dislike the Patriots more. Ugh. So go Seahawks. I hope they win. Have a great weekend, and we'll see you next Friday. Take care. Gaylord out.